Hey, Morgan. Yeah, this is an area to watch. The private credit industry has ballooned in recent years as regulation forced traditional banks to rein in lending, and low rates prompted companies to take on more and more debt. But some are concerned that the $1.2 trillion industry may soon reach a tipping point. PIMCO's CIO Dan Ivison flagged this risk at Delivering Alpha in September. Bleakley's Peter Bookvar emailed me after an earlier segment on the topic today, saying private credit is his, quote, biggest concern right now. That's because, in part, this type of debt is typically floating rate. So as the Fed continues to hike, investors generate more income, but the borrowers have to shell out more cash to service higher interest payments. A recent test by Kroll applied interest rate stresses across thousands of middle market private companies and found that a terminal Fed funds rate of 525 basis points would lead to a 60% increase in interest expense. As a result, more than 16% of companies they looked at wouldn't generate the needed cash flow to cover the higher payments, a statistic that doesn't even incorporate the impact on margins from, say, a potential recession and inflation. Now, the concern is that may lead to a wave of defaults, which would create losses, of course, for investors as well, guys.
I mean, it's such a key point, Leslie, and it kind of strikes sort of at this whole idea of a so-called Fed pivot or a Fed pause. If the Fed was actually going to start pausing now, based on the data laid out in front of it, I mean, that's the counter argument, right? That systemic risk is growing and that something's potentially breaking. But that being said, some of the companies that you're referring to, publicly traded, what are they saying about this in their earnings calls so far?
Yeah, so you've heard from KKR this morning. Ares last week is very big in the private credit space, and they basically say that so far they're not seeing much in the way of material credit weakness, that actually they're being opportunistic as big banks are pulling back. We've seen this a bit with deal financing and the inability to syndicate the debt. And so these private credit firms are really stepping in to fill that void. What's interesting is that given kind of where rates are right now, despite the fact that they've risen so fast, it hasn't created as much pain as perhaps I think some might have expected. But the Kroll report, that stress test, indicated that, things could get ugly pretty quickly, especially once you surpass that 5% threshold.
All right. Thank you very much, Leslie Picker. We appreciate it.
Shepard Smith here. Thanks for watching CNBC on YouTube.